You know, whenever the market makes a big, fast move, it doesn't just disappear without a trace. It actually leaves behind clues, sort of like footprints in the sand. Today, we're going to learn how to spot those footprints and figure out what they're telling us about where the price might be headed next. So, let's get into it.
Seriously, have you ever seen one of those massive candles just explode on your chart and think, what just happened? Well, that incredible speed creates a hidden story right there in the price action. It's not just a move, it's an echo, an imbalance, a void that the market almost feels compelled to go back and check on later.
And these voids, these little hidden gaps, are what traders call fair value gaps, or FVGs for short. They pop up when the price goes so hard and so fast in one direction that it kind of breaks the normal flow of the market, leaving behind an inefficiency.
So the key idea here is this concept of imbalance. See, a healthy market is like a good conversation. There's a back and forth between buyers and sellers. But an FEG tells us that for a brief moment, it stopped being a conversation and became a monologue. One side just completely took over, and that imbalance is the footprint we're hunting for.
Okay, but not all imbalances are created equal. They actually have a direction and a specific name, depending on whether the market shot up or rocketed down. Let's break down the two types you absolutely need to know.
And this slide just lays it out perfectly. On the left, you've got your normal two-way street. Buyers and sellers are doing their thing. But on the right, that's a one-way highway at rush hour. The price is just flooring it, and there's no one from the other side, even on the road. That one-sided action is exactly what carves out the gap.
First up, we've got something called a BC. It stands for buy-side imbalance, sell-side inefficiency. Yeah, it's a bit of a mouthful, I know. But all it really means is that during a big move up, the buyers were so aggressive, they left no fair chance for sellers to get in on the action. You'll see these everywhere, in strong bullish trends.
And on the flip side, we have this SIBI, sell-side imbalance, buy-side inefficiency. This is what happens during a sharp bearish drop. The sellers are just in total control, slamming the price down so fast that any potential buyers are just left in the dust, with no fair price to step in and participate.
Okay, theory is great, but how do we actually find these things on a real chart? Well, the good news is there's a super simple 3-candle pattern that works every time. Once you learn this, spotting any FVG becomes second nature. So let's start with the bullish one, the BSI. It's just a 3-step process. First, find 3 strong green or bullish candles all in a row. Easy enough. Second, you mark the very highest point of that first candle, the top of the wick. And third, you mark the very lowest point of the third candle. And right there, if the wicks from candle 1 and candle 3 don't touch, that space in between them, that is your fair value gap. That's the imbalance, the footprint left behind by those super aggressive buyers. Simple as that. Now for the bearish gap, the SIBI, we just flip that logic completely on its head. First, you find 3 strong red bearish candles in a row. Then, step 2, you mark the absolute lowest point of that first candle. And finally, you mark the highest point of the third candle. And if those wicks don't overlap, the space between them is your SIBI. It's the exact same principle, just inverted. And I'm telling you, once you train your eye to see this pattern, you are going to see these gaps absolutely everywhere. So it's cool that we can find them, but what's the point? Why does it matter? Well, it matters because these gaps act like magnets for price. The market fundamentally dislikes inefficiency, and it has a tendency to want to go back and, well, fill in the gap. This quote really gets to the heart of it. Think of it like a vacuum. Nature hates a vacuum, right? Well, the market hates an imbalance. There's this natural pull for price to return to these inefficient areas to restore balance before it decides where to go next. So here's how we actually use this. A bullish FVG, the buy-side, often acts like a floor or a support level. You'll see price shoot up, leave the gap, and then pull back into that zone before finding the footing it needs to launch higher. And the bearish FVG, the SIBI, does the exact opposite. It acts like a ceiling or resistance. Price rallies back up to it, hits that zone, and then often gets rejected back down. All right, you ready to take this to the next level? The real magic happens when you start combining information from different time frames. The pros don't just stare at one chart, they build a story, starting from the big picture and zooming into the fine details. Now, before we get to the strategy, there's one more key term you need to know: consequent encroachment. It sounds super technical, I know, but don't worry. All it is the exact 50% midpoint of the fair value gap.
It's a line in the sand, and it's a critical level to keep an eye on.
So why is this 50% level such a big deal? Because a reaction right at this midpoint is often a really, really strong signal. If price dips into a gap but gets bounced right off that halfway point, it's telling you the market is strongly respecting that imbalance. It's a high probability area.
Okay, let's put all the pieces together. Here's the pro-level game plan. You start on a higher time frame, like a daily or a 4-hour chart, to find your major fair value gaps. This is your big picture analysis. You draw your box around the gap and mark that 50% level. Then, you zoom into a lower time frame, like the 1-hour or 15-minute, to actually time your entry. You wait and watch for the price to hit that zone you found on the big chart.
And this table is basically your cheat sheet for that. If you find a really clean FVG on the daily chart, you then drop down to the 1-hour chart to look for your entry signal. If your main analysis is on the 4-hour, you're hunting for your setup on the 15-minute. See how that works? You align the big idea with a precise small-scale entry.
So there you have it. You've got a whole new lens to see the market through. These gaps, these footprints, they aren't just random noise. They're telling a story about speed and inefficiency. They tell you where the market has been and, more importantly, where it might be drawn back to in the future. The only question left is, now that you can see them, where are they going to lead you?